NIO stock started the week with a subdued session, shedding just under 10 cents to close at $7.59 per share, down about 1.2%. On the surface, that looks like an unremarkable move after the swings we've seen in recent weeks. But there's a deeper story behind Monday's quiet action. It's the story of a stock consolidating under resistance, a company delivering record numbers, and a sector adjusting to new rules and shifting sentiment. As NIO drifts sideways between $7 and $8, investors are watching for the next catalyst that could trigger a decisive breakout or another leg of consolidation. For weeks, NIO has been engaged in a tug-of-war between buyers and sellers. Each time the stock approaches the upper sevens, profit-taking and short-selling tend to emerge. Each time it dips towards $7, buying interest reappears. This repeated pattern of bouncing off support and stalling at resistance is a sign of accumulation. It shows that stronger hands are absorbing supply while weaker hands exit. Monday's close at $7.59 is another iteration of that pattern. It's not a breakdown but a pause at mid-range, with buyers waiting for a trigger to push it higher. A key piece of context for Monday's session is Tesla's recent delivery report. Tesla announced record quarterly deliveries of 497,000 vehicles worldwide, up more than 7% from the year before and exceeding many forecasts. Much of that surge was driven by U.S. buyers taking advantage of federal tax credits before they expire, but even after adjusting for that, the performance was strong. For the electric vehicle market, this is a validation of demand. It shows that even in a challenging macro environment, consumers are still buying EVs at scale. For NIO, it's both an opportunity and a challenge. On one hand, Tesla's beat lifts sentiment across the EV sector and attracts capital into the theme. On the other, it raises the bar for competitors and can prompt investors to rotate funds into the sector leader at the expense of secondary names. You could see some of that dynamic in Monday's trading. Early in the day, NIO hovered higher, reflecting positive spillover from Tesla's numbers and from NIO's own strong delivery trends. As the session wore on, enthusiasm faded and some profit-taking set in. Without a fresh catalyst of its own, NIO drifted lower and closed modestly down. This is normal behavior for a stock consolidating under resistance. It's the market waiting for more information before making its next move. Another important backdrop is China's new export permit policy for electric vehicles, which will take effect in 2026. Under the new rules, automakers will need government permits to export cars, with a stated goal of safeguarding the image of Chinese brands overseas by ensuring quality and compliance. Initially, the announcement worried investors about added bureaucracy. But for premium players like NIO, it could be a net positive. The company has invested heavily in its brand, its battery swap infrastructure, and its sub-brands Onvo and Firefly. In a world where only authorized, high-quality producers can export, those investments become a moat. Fewer low-end competitors undercutting prices in Europe or other markets would strengthen NIO's positioning and protect its margins. This regulatory shift is still years away, but it's shaping how investors think about the long-term opportunity. While the stock price consolidates, the fundamentals have been improving. NIO delivered 34,749 vehicles in September, a new monthly record. In the third quarter, it delivered 87,071 vehicles, up more than 40% year-over-year. Those are impressive numbers in a competitive market. They show that NIO's products are resonating with consumers despite economic headwinds. They also give analysts confidence to raise price targets. UBS recently lifted its target to $8.50, citing strong deliveries and the potential for near-term upside. These operational milestones act as a foundation under the stock even when short-term trading is choppy. Another quiet but telling shift is in the company's short interest. In September, NIO's short interest dropped by more than 5% to about 9.8% of the float. That's a meaningful change. It suggests the stock is no longer in the highly shorted category and that some of the speculative bearish pressure is easing just as the company's fundamentals are strengthening. A lower short interest means there's less fuel for a dramatic squeeze, but it also means the price is less likely to be capped by constant selling from new shorts entering at resistance. It can set the stage for steadier upside driven by fundamentals rather than forced buying. The technical picture remains clear. $7 is the floor that has to hold to keep the bullish setup intact. $7.80 to $8 is the ceiling that has to be broken to signal a new leg higher. In between is a zone of consolidation where accumulation continues. Monday's close at $7.59 places the stock right in that zone. It's a quiet day in a stock that's quietly preparing for its next move. For long-term investors, this is a healthier setup. Volatility driven by shorts can be exciting, but it often ends in a round trip. A base built on real buyers is more durable. For traders, it means adjusting expectations. There may be fewer dramatic squeezes but more tradable trends. For NIO itself, it means the market may be starting to take it more seriously as a business rather than just a speculative vehicle. Looking ahead, the catalysts to watch include any further clarity on the export permit system, updates on NIO's European expansion, and of course monthly delivery numbers. Sector sentiment will also be influenced by Tesla and other peers. If Tesla's strong results translate into sustained optimism for EV demand, that tailwind could help NIO's breakout attempt. If concerns about regulation or competition dominate, the stock may continue to consolidate until a clearer trigger appears. The weekend is a good time to step back from the noise of intraday trading and see the trends that matter. NIO's price is still below its recent highs, but its fundamentals and investor base are shifting in a positive direction. The stock may not be heavily shorted anymore, but that's not a bad thing. It means the story is maturing and the next move could be based on real conviction rather than short covering. With support holding, fundamentals improving, and regulatory and competitive dynamics shifting in its favor, the company remains one of the more compelling plays in the Chinese EV space. This is the calm before the next catalyst. Whether the breakout comes next week or next month, the groundwork is being laid. For investors and traders alike, this is a weekend to pay attention to NIO, not because of a 1% dip or a 2-cent rally, but because of the deeper shifts that could shape its future performance. NIO has defended support, delivered record numbers, built a premium brand, and prepared for overseas expansion under a new regulatory regime that may favor quality exporters. Tesla's record deliveries validate the demand story while raising the bar for competition. Shorts are backing off. These are the ingredients of a potential re-rating. The question is when, not if, the market recognizes it.